Okay, students, we're back now, and we will start by covering brief exercise 13.4. So, Branch Corporation issued $12 million of commercial paper on March 1 at a 9% on a 9-month note, Interest was discounted at issuance at a 9% discount rate. Prepare the journal entry for the issuance of the commercial paper and its repayment at maturity. So March 1st, it was the commercial paper was sold. It's 9-month note. So 9 months later, March is the 3rd month. So 9 months later would be 12th month, or December 1st, or really November 30th would be most likely when the maturity would occur. So on March 1st, we have to record the sale of the commercial paper. $12 million. It was discounted at 9%, and it's a 9-month note. So to calculate the amount of the discount, we would take $12 million times the 9% interest times 9/12 of the year. And that comes out to $810,000 is the amount of the discount. That's the amount of interest that will accrue for the 9 months. So when we sell the commercial paper, we're going to credit notes payable for the $12 million face amount of the commercial paper. We're going to debit the discount for the amount of the discount, or the amount of interest that's built into that $12 million. Then we're going to debit cash for the amount of cash we receive, which is the difference between the $12 million and the discount, $11,190,000. Okay. Then on November 30th, when the note matures, we're going to need to convert the discount to interest expense, because now we have incurred all that interest. So we debit interest expense, credit discount on notes payable for the entire $810,000. Now the discount has gone away, debited here, credited there, so that gives us a zero balance. And we pay off the commercial paper. So we credit cash for the $12 million face amount that we have to pay, debit notes payable for $12 million, removing the note from our books, and that's it. Okay, let's move on to brief exercise 13.5. And right here, Life.com issued $10 million of commercial paper on April 1st on a 9-month note. Interest was discounted at issuance at 6% discount rate. What is the effective interest rate on the commercial paper? Okay, we saw in the book earlier in the last video, or maybe the video before that, I'm not sure, but we saw how to calculate the effective interest rate. It's really not very hard. We're not really borrowing $10 million because it's being discounted. So first we need to figure out how much is the discount. So to get that, we take $10 million times 6% times 9/12. That'll give us the amount of the discount. So $10 million times 6% times 9/12 gives us $450,000. So the amount of cash we receive is $9,550,000. Now on that $9,550,000, we're going to pay $450,000 interest. So we divide $450,000 by the $9,550,000, and that gives us 4.712% interest paid for 9 months. Now to convert that to an annual rate, we need to divide it by 9 and then multiply by 12. So multiplying it times 12/9 gets us to that annual interest rate, which comes in at 6.3%. So even though the discount rate was 6%, our effective interest rate is 6.3%. Okay, that gets us through those homework problems. So we're through here. I talked in a prior video about accrued liabilities, but let me just cover them again real quickly. And accrued liabilities exist because at the end of an accounting period, when we get ready to prepare financial statements, there are certain expenses that we have incurred, but we haven't yet recorded. So we have an expense, we have not recorded it. Expenses are things that are going to ultimately require us to pay. We haven't paid it yet, so we have a liability for that. That's an accrued liability. So what are the kinds of things that generate accrued liabilities? Salaries, utilities, interest. 3 that come to mind immediately. All 3 of those at year end, we usually have incurred some expense that we have not recorded. So how do we record those? Well, as I said, we debit an expense account. So right here you see interest expense, interest being accrued. We debit interest expense, credit a payable, interest payable here. If it were salaries, then it would be debit salaries expense, credit salaries payable. If it were utilities, it would be debit utilities expense, credit utilities payable. Then whenever we pay this, we need to always remember that we need to remove this payable. So later when they pay the interest, you're going to debit interest payable for the $14,000 that was accrued right here. We've already recognized the expense for that on June 30th. So November 1st, when we pay off the note, we don't want to expense this again. It's already been recorded as an expense. I was going to say been shown up, but that doesn't make sense. But it's been recorded as an expense. We have to remove the payable. So we debit interest payable for the amount of interest accrued on June 30th. We debit interest expense for the additional interest that has been accrued since June 30th. We debit notes payable for the face amount of the note, and then we credit cash for the amount of cash paid. Okay, now vacation, sick leave, things like that are a little bit of a tricky issue. Technically, if an employee earns vacation in one year and takes that in a subsequent year, in the year that they earn the vacation, you need to recognize the expense for it and accrue the liability. So you would debit an expense for it, credit vacations payable. Now, then we get into the definition of when we have to accrue contingent liability, and we haven't covered that yet, but it's when it's probable that we will have to pay the liability and we can reasonably estimate the amount. Now with vacation, we can reasonably estimate the amount, and it's probable that it might be taken if it can be carried over. So if both of those are present, you should record the liability. Now, a lot of big corporations basically allow you to take the vacation during the year that you earn it. And so in those cases, if they don't allow vacation carryover, or it's unlikely the employee will take vacation in a subsequent year, or not probable the employee will take the vacation in a subsequent year, there would be no need to accrue an expense and a liability. Then with sick leave, that one becomes especially tricky because it depends upon whether they get paid for sick leave if they don't take it. Now, if they don't get paid for untaken sick leave, and an example of that, my previous job at my previous university, I'd been there for 24 years, and when I retired, I had over 6,000, over 3,000 hours of accumulated sick leave. I didn't get paid for that. I actually got paid for 200 hours of it was all. So should they have accrued an expense? Well, they probably should have accrued an expense for 200 hours since that was the maximum you could be paid for. But the rest of it, they didn't need to accrue it because it was not probable that I would ever take it. So right here you get into a little box, kind of explains the conditions for accrual of pay for future absences. The obligation is attributable to the employee's services already performed. The paid absence can be taken in a later year. In other words, the benefit vests, will be compensated even if the employment is terminated, or the benefit can be accumulated over time. Payment is probable. That one's really important, and the amount can be reasonably estimated. Okay, and you see that discussed right down here in your textbook. Right here, they kind of some important information about those issues. Custom and practice often influence whether unused rights to paid absences expire or can be carried forward. Obviously, if rights vest, payable even if employment is terminated, they haven't expired. Holiday time, military leave, maternity leave, jury time typically do not accumulate if unused. So liability for those benefits is usually not accrued and usually not appropriate to accrue. On the other hand, if it's customary that a particular paid absence, say holiday time, can be carried forward, if employees work on a holiday, in this case, a liability is accrued if it's probable that employees will be compensated in the future. Interestingly, sick leave quite often meets the conditions for accrual, but accrual is not mandatory because future absence depends on future illness, which usually is not a certainty. So there we get into some of the intricacies there. I'm not going to get into any more detail on it than that. Annual bonuses. Bonuses are compensation expense in the period in which they are earned. So unpaid bonuses are accrued as a liability at year end. Always true if it's been earned. Now, deposits and advances from customers. For example, customers purchasing a gift card. At the time the customer makes the purchase, we debit cash, we credit a liability, deferred revenue or unearned revenue. Then when the customer uses the gift card, we debit unearned revenue or deferred revenue and credit the sales revenue account. So they kind of walk you through that. Deposits are the same thing. When a deposit's forfeited, then you debit the unearned revenue or deferred revenue and credit the revenue account. Okay, here they talk about the gift cards. Now, I will pick up with gift cards because there's a few more things I want to say about gift cards, but our time for this video is just about to run out. So I'm going to stop now and I'll start with gift cards on the next video.